Hello taxpayers, welcome to the Reliable Accountants educational web series. Today we're diving into the nitty-gritty of capital gains tax, or CGT, on inherited properties in Australia. Now I know tax rules can be a bit dry, but bear with me, I'll break it down with some practical examples to make it crystal clear. First up, let's talk about inherited property as your principal place of residence, or main residence. If you inherit a home that was the deceased's main residence, and you sell it within 2 years of their passing, it's generally exempt from CGT. Simple enough, right? Let's use Sarah as an example. Sarah inherits her mother's home, which was her mother's main residence. She decides to sell it 18 months after her mother's death. Because the sale happened within 2 years, Sarah doesn't have to worry about CGT. Nice and straightforward, but what if you hold on to the property for more than 2 years? This is where it gets a bit more complex. If you sell after 2 years, CGT might kick in. However, if the property was the main residence of the deceased at the time of their death and wasn't used to produce income, you might still be eligible for a CGT exemption. Take John, for instance. John inherits his father's home, moves in and makes it his main residence. He sells it 3 years after his father's death. Since it was his main residence and wasn't used for income, John could be eligible for a full or partial CGT exemption. Now, let's switch gears to inherited investment properties. If the deceased acquired the property before the 20th of September 1985, it's generally exempt from CGT up to the date of death. After that, any capital gain is calculated from the market value at the time of death to the sale price. For example, Emma inherits an investment property her uncle bought in 1980. At the time of his death in 2024, the property's market value is $500,000. Emma sells it in 2025 for $550,000. Her capital gain is $50,000, calculated from the market value at the date of death to the sale price. If the property was acquired by the deceased on or after the 20th of September 1985, you inherit it with the same cost base as the deceased. The capital gain is the difference between the sale price and the property's cost base. Liam's situation is a good example. He inherits an investment property his mother bought in 1990 for $200,000. Liam sells it in 2025 for $600,000. His capital gain is $400,000, calculated as the difference between the sale price and the original cost base. Remember, the main residence exemption can apply under certain conditions. If the property was the deceased's main residence and wasn't used to produce income, and you sell it within 2 years, it may be exempt from CGT. And don't forget to keep detailed records of the property's acquisition date, value at inheritance, and any expenses. This information is crucial for calculating potential capital gains or losses accurately. For any tax-related queries, please reach out to Reliable Melbourne Accountants at 1300049534 or send an email to inquiry@ourmelbourneaccountants. Thanks for watching and stay informed.